You've probably seen Pediasure or Ensure on the shelves, right? Well, that's Abbott India. They're a massive player in healthcare. But here's the big question we always have to ask. Does a great company automatically make a great investment? Let's dive in and really decode this one. See if the price tag matches the quality. Okay, so first things first, where does the money actually come from? It's a really interesting mix. Almost half, 45%, comes from their nutritionals. Think of the products we just mentioned. Then you've got another big chunk, 40%, from pharmaceuticals, stuff for chronic care. And the last 15% is in diagnostics. This kind of diversification is key, It gives them a really stable foundation, but also lots of different ways to grow down the road. All right, so here's how we're going to break this down. First, we'll look at the big picture, the market they're in. Then we'll pop the hood and do a full financial health check. After that, we'll figure out their secret sauce, their business moat. Then we get to the juicy part, the quality versus price debate. And finally, we'll wrap it all up with the analyst's final verdict. Let's get started. Okay, section 1. Let's talk about the world Abbott lives in. A company can be great, but if it's swimming against the current, it's going to struggle. The good news for Abbott, the water they're in is moving fast in the right direction. I mean, look at this. Abbott is basically riding a massive wave of positive trends in India. You've got more people spending on healthcare, a growing awareness of health and wellness, and an aging population that naturally needs more care. On top of that, there's a rise in chronic diseases, which means long-term customers. And if that wasn't enough, you have the government pushing initiatives to expand healthcare access. It's pretty much a perfect storm for a company like Abbott. So, the market conditions are fantastic, a huge tailwind pushing them forward, but what about the company itself? Is the engine running smoothly? It's time for a proper financial health checkup. Let's look at the vitals. And right off the bat, the first vital sign looks incredibly strong. Just look at this growth. We're talking going from around 3,600 crores in 2020 to over 5,800 crores just 4 years later. That's a compound annual growth rate of about 12.5%. That's not a sudden spike. That's steady, consistent, reliable growth. Exactly what you want to see. Okay, growth is great, but what about risk? A classic way to check for risk is the debt-to-equity ratio. Don't let the name scare you. It's super simple. It just asks how much of the company is funded by borrowed money versus its own money. And for this number, lower is always, always better. Less debt means less risk. So what's Abbott's number? Get this, it's 0.08. I mean, that is just incredibly low. For all practical purposes, this company is debt-free. They are not beholden to lenders, they're funding their own growth, running their own show. That is a massive sign of strength. And this isn't just some boring accounting detail. Being debt-free is like a financial superpower. Think about it. When times are good, they can pour money into growth without asking a bank. When times are tough, they don't have that crushing weight of interest payments that can sink other companies. It gives them this incredible flexibility and stability. It's a huge competitive advantage. All right, so the financial report card is basically perfect. But strong numbers can attract competitors, right? So what's stopping them? Every truly great company has what investors call a moat, something that protects it, something that's really hard for anyone else to copy. So let's figure out what Abbott's secret sauce really is. And it's not just one thing, which is what makes it so powerful. You've got these powerhouse brands like Pediasure that parents trust implicitly. That's loyalty. Then they have this massive distribution network that gets their products literally everywhere. That's reach. Plus, they get to tap into the huge R&D budget of their global parent company, so they're always innovating. And maybe most importantly, they have these rock-solid relationships with doctors. When you put all of that together, that's a fortress. It is incredibly tough for a competitor to even try to get through that. And if you're looking for the proof in the pudding, here it is. In this super important pediatric nutrition space, Abbott owns more than 25% of the market, a quarter of the entire market. You don't get that kind of dominance by luck. That is a direct result of that moat we were just talking about. It just works. Okay, let's recap. We have a fantastic business operating in a booming market with financials that are squeaky clean and a powerful moat protecting it. I mean, it sounds almost too good to be true, right? Well, there's always a but. And this is a big one. So, with a report card like this, you're probably thinking, okay, where do I sign up? This is a slam dunk, an automatic buy. And I get it, but this is where investing gets tricky because it's not just about buying a great company, it's about the price you pay for that greatness. And this chart lays out the problem perfectly. We're looking at the PE ratio. which is basically a fancy way of asking, how much are investors willing to pay for 1 rupee of the company's profit? For Abbott, that number is over 43. Now compare that to its peers like GSK or Pfizer, they're in the 30s. So investors are paying a hefty premium for Abbott stock. The market knows it's a high-quality company, and that quality is already baked into the price. And this right here is the heart of the debate for any investor looking at Abbott. You have two camps. The bulls say, yeah, it's expensive, but look what you're getting. You're buying safety, quality, and predictable growth. It's worth paying up for that. But then the bears come back and say, whoa, hold on. That price is way too high. There's no margin of safety. If anything goes even slightly wrong, the stock could get hit hard, and your potential upside is capped. It's a classic tug of war. So you've got this amazing quality on one side of the scale and this really high price on the other. How does a professional analyst balance that? Where do they land? Let's get into the final verdict and see. And here we have it. The final score from the Web Cornucopia report is a 7.9 out of 10. Now that is a really good score, no doubt about it. They call it a proficient company. But it's not a 9 and it's not a 10. And the reason why it's not a near-perfect score is the most interesting part of this whole story. This breakdown really tells you everything you need to know. Look at these numbers. Financial health, a massive 8.8 out of 10. Fantastic. Competitive position, a strong 8.2. Management quality, 8.5. Everything is just stellar, stellar, stellar. And then you hit valuation, and it's a 6.2. That's the one thing. The one clear issue that's holding this company back from a truly elite score. That high price tag is the anchor pulling the overall grade down. But even with that lower score for valuation, the report's final takeaway is actually pretty clear. The analyst still comes back to the core strengths, calling it a quality business, and pointing to that incredible financial strength and the very visible path for future growth. So where does that leave us? Well, the final recommendation is a buy. The report sets a target price of 31,500 rupees, looking out over the next 12 to 18 months. But notice the risk rating, moderate. And why is it moderate? It's all because of that high valuation. So in the end, the analysis makes a choice. It says, yes, it's expensive, but we believe the quality of this business justifies paying that premium. And that really leaves us with the big question, one that every investor has to grapple with. The whole story of Abbott India comes down to this classic debate. Is paying up for a fantastic, safe, predictable company a timeless winning strategy? Or, in today's market, is it just a risky bet, paying a high price for a story that everyone already knows? That's the real takeaway here, and it's definitely something to think about for your own portfolio.